Hey guys, thank you. Welcome and good evening. My name is Jesse Reynolds. I'm excited to visit with you for about the next 30 minutes about this infinite banking, why and how. This is something that I've been working on for a while. Just super quick background about myself and my wife. We've been in this space now for about 3.5 years in the wealth strategy space. We had heard about infinite banking for years. It was always interesting. We kind of had some hangups, some unanswered questions. That all changed for us about 4 years ago when we finally read a book called What Would the Rockefellers Do? And it just connected the dots. It removed some of the confusion. It removed some of the hype, because honestly, there's a lot of hype and misinformation out there as well for us. And ever since that time, not only have we started practicing this specific financial play for ourselves, but we've helped literally hundreds of families across the country in about 40 different states now implement the strategy. And it's powerful to when you start to learn about it, understand what it is. And so I want to try to answer some questions, remove some confusion, and also address some bad information that's out there from people in this space who promote and claim to help folks and really just make a lot of exaggerations out there as well. So we're gonna remove the hype, and we're gonna hopefully help all of us on here tonight learn how to become more efficient with our money. So, have you heard about the infinite banking concept? Probably if somebody has invited you on here, I mean, you at least heard about it because they said, hey, there's this thing going on tonight. But the reality is it's got a lot of different names. So whether you hear, me or somebody out there say infinite banking concept, IBC, private family banking, just any of these terms here on the screen, they're all talking about the same play. One honestly that is actually super descriptive but kind of sounds funny is the Swiss Army knife of financial tools. That'll probably make more sense over the next few minutes as we kind of unpack this. And it just simply has to do with the versatility and the different applications of what you can do with this. But did you know that this play has been around for about 200 years? It's not some sort of latest greatest fad, and many ultra wealthy families love it. And honestly, that was for me one of the hangups, because a lot of the people I knew who were doing this were all super wealthy, and I thought that you had to be like ultra rich in order to implement it, which is absolutely not true. But at the same time, success leaves clues, right? So as I did finally start really diving into this and understanding some of the ins and outs of it, it was very curious to me, why did some of these multi-billionaire families choose to implement this? And hopefully that will make more sense for you again over the next few minutes as we go through this. So like I said, this is not something new. It's been around for a couple centuries. It's not too good to be true. It's not a gimmick. Again, there's a lot of people who hype it and try to over promote it. Like I talked about, you don't need to be ultra wealthy to implement this. It's really just math, and it really just comes down to understanding certain contractual provisions that are available that can help us create more efficiency with our money. Again, some of that stuff is just kind of being repeated here, but that last line there about how it is misunderstood by the masses, that is absolutely true. And so we're going to try to remove some of the confusion around it, because if you do better understand what the tool is, tools can have great benefits for us, but if we don't understand what they are, they're not super helpful, right? If imagine if you had a indigenous tribe somewhere, and you dropped off like a super sweet SUV on like a Range Rover or something, and all you did was show them that it played music, right? You just turned the stereo on. The point of the Range Rover is that it can transport groups of people long distances in a short period of time efficiently. But just because you give that to them, if you don't show them how to put the gas in the ignition, turn the thing on, use the gas, the pedal, the brake pedal, steering wheel, all those things, it's not until you understand the applications of it that it really begins to positively impact their lives. And so that's why we want to try and remove some of the misunderstandings around it, and hopefully have you feel much more empowered about how this play can fit in for your family. So, so again, back to like why why is it that so many ultra wealthy families have loved this play? It's for a lot of reasons. And this is kind of about that phrase where some people refer to it as the Swiss Army knife of financial tools, because it does give you tax-free growth with your money, but also tax-free access with your money, which is really important. You can utilize the power of compounding interest. We're going to talk about that, showing a real example a little bit later about creating interest arbitrage. You can actually, why some people talk about it as like cash flow banking or private family banking, is over time you can begin to finance several major purchases like vehicles and homes and things like that through your private family banks. And so you can start recapturing the interest there. And ultimately, it lets you have more control over the banking function in your life. You can create more liquidity and control of your money. This isn't to criticize retirement plans, 401ks, things like that. But the reality is, most people don't understand that it's not just about, the quote unquote rate of return, but also the rate of results. And what are opportunities that you fail to take advantage of when your money is locked up in something until the age of 59 and a half, right? There's actually contractual guarantees of growth and protection of your money. Also, just as an asset, in most states, your money is protected from litigation and creditors. And ultimately, and this is like the play behind the play, which goes back to that book I mentioned, What Would the Rockefellers Do? It's gonna create a way for you to have a tax-free legacy wealth transfer multi-generationally. That is the ultimate outcome that we want to create with this. But you have to do it the right way. It doesn't just happen, and we'll talk through that some more as well. And even in the very short term, this is one that we'll break down in a minute. It is a superior emergency fund, and that I'll prove that for you in just a moment. But so first off, what is it exactly? Right? I keep talking about this concept, this term, infinite banking concept. So let's clearly define it. It is a financial strategy that utilizes a specifically structured, high cash value, dividend paying, permanent life insurance policy. That's a mouthful, right? But all of those words are very specific, okay? And that's why I wanted to be comprehensive in that definition for you, because again, some people will throw around those terms and they're not talking about the same thing that I'm describing here for you guys. So it has to be properly structured, which we'll break down. You want a part of that structure, you want to be able to have a high cash value with an access to that cash value. Again, that goes back to the right contractual provisions. You want it to be dividend paying. That simply means you need to use a mutual life insurance carrier so that you are getting dividends paid into the policy every year, which both grow the cash value and the death benefits. And you want to have a permanent life insurance product. That part's super important too, because and really gets into some of the misrepresentations of this out there by people in the space. Is they try to overemphasize certain aspects, but they fail to structure it in a way that it is going to have this ultimate tax-free legacy wealth transfer, which I believe is the most powerful part of this play, but it is certainly not the only part of this play here. So, okay, so I'm not getting political, I promise. Some of you just heard me say life insurance, and you're like, what are you talking about using life insurance as an asset, right? And so neither of these candidates promote life insurance. It's not the point I'm trying to make. But it reminded me of a story. We're back in 2016 when Trump and Hillary were running against each other. And Hillary was criticizing Trump, saying, you don't pay your fair share in taxes. And Trump was saying, yes, because I'm smart. I'm not promoting either of these guys, but he's saying, yes, because I'm smart, because I utilize the tax code that you and your buddies in Washington put in place. And this is the point that I'm making. Some of you are seeing this in here in life insurance, like, what's exciting about life insurance? What's powerful about life insurance, right? Like, yeah, I got a term policy, whatever. That's not what we're talking about. But my point is, several ultra wealthy people become ultra wealthy simply because they decide to become curious about things that the masses are just uninterested in. And that's what I want to invite you into. Whichever one of these guys you might have liked or voted for 8 years ago, I want to invite you into becoming curious about something that you maybe don't fully understand, that once you do understand it, could create a way for you to become more efficient with your money, okay? But like I said, there's a lot of people out there who hate whole life. And I'm not trying to knock on Dave Ramsey. I live in Nashville. I go to church with people, with friends who literally work for the guy. I think he's done a lot of good for people, but he hates whole life insurance, and he is not nice about it. And that's fine. I'm not here to argue with him. But the reality is, there's really four big players. He's a part of one of the four. But there's really four big players who do not like this play. And the reason they don't like this play has to do with money, because they make way too much money having the average American not know about this, understand it, or utilize it, okay? And so remember I said this play's been around for 200 years. This is not some sort of latest, greatest gimmick or money trick. This is a timeless, proven concept that has been utilized for a couple centuries now, okay? But did you know that the tax code has only been around for a little over 100 years in America? Like, all of our lifetimes, all we've known is income taxes. But there was a time in America where Americans didn't pay taxes. It's kind of wild to think about. But so, there's four major forces who really benefit from people not knowing about this, because Having cash value life insurance was a very normal play before the 70s. So the government doesn't love it because, spoiler warning, they don't love our money growing tax free. Wall Street doesn't love it. If you're, and these are all things you can go Google it, go down the rabbit trails. I'm not trying to spit conspiracy theories here, but prior to 1974, when the government got in bed with Wall Street and they came up with something called the Employee Retirement Income Securities Act, ERISA, commonly referred to as ERISA. When the government got in bed with Wall Street 50 years ago, they started automatically funneling people's money into Wall Street. The masses did not have large shares of their wealth in Wall Street prior to the 70s. And since then, it's just been an automatic funneling. And not only has it been automatic funneling, but in the early 70s, the largest population in the history of America, the baby boomers, were all starting to enter the workforce. So you have the largest population bubble ever coming through the workforce, and you start automatically funneling money from them month after month, year after year into Wall Street for the past 50 years. Wall Street guys have loved ERISA. It's been amazing for them and all these qualified retirement plans. Prior to that, most people just had pensions and cash value life insurance was where the majority of the average Americans had their money. Money guys don't love you knowing about this. And again, I believe a lot of money guys are very well intended. I'm not trying to be critical of them, but I understand that we're all humans and we all respond to incentives. And so the reality is, since the early 70s, this whole new financial services industry with qualified retirement plans and 401ks and IRAs and all those things, those guys, they suffer from what I would say is when all you have is a hammer, everything looks like a nail, right? And so their whole game is assets under management. It doesn't mean that they're bad people. I'm not criticizing the market. I'm not saying that they don't make their clients money, but what I am saying is, if you're making 2 or 3% a year every single year off a client for 30, 40, 50 years, it takes a rare breed to then start telling them, hey, you should start putting your money other places where I don't get paid to manage it, right? That's just the reality of what's happening for a lot of folks. And then even, financial entertainers, that I'm not picking on any of them specifically, but whether Dave Ramsey, Susie Orman, any of those guys. So I've heard Dave Ramsey's rants on whole life insurance, and he's inaccurate with some of the statements that he makes, and he tends to become very lively and animated. Again, Dave has helped probably tens of thousands of Americans get out of debt across America, however long his career's been. He's done a lot of good things, but at the end of the day, it's kind of his shtick, right? He yells at you and what are you, a moron, and all that type of stuff. It's entertainment. He's built a brand, right? That's just kind of what they have there. And the reality is, he's a big advocate of buy term and invest the difference. A lot of those the money entertainers are. And it just happens to be for your convenience. You could just go invest the difference in the market with one of his credited Dave Ramsey SmartVestors who pay thousands of dollars a year to advertise on his sites. I'm not saying it's a bad play, but what I'm trying to say is if as we go through these benefits of whole life insurance, the infinite banking concept, doing it the right way, and you keep coming up against, well, why aren't more people doing this? Why is this what I hear about on TV? Why is this what my money guy told me to do? What, there's a reason, and it has to do with too many people have their hands in the pot with one plan. They all financially benefit from the system that we're all being shown, but any of us can choose to unplug from the matrix at any time and pursue a different strategy for wealth creation with it. So can you do this with any policy? Absolutely not. Not only can you not do it with any policy, but you actually can't do it with the majority of policies. You need three things. You need to have the right carrier. We already talked about mutual carriers that pay dividends. That's super important for growing the cash value and the death benefit long term. You got to have the right product. Even inside of a mutual carrier, they probably have they oftentimes have several different whole life options. You want one that gives you a high percentage of cash value in your premium. We're going to break that down more in a minute. And accessibility to that cash value. I won't go too much into that one right now, but there's a lot of carriers, a lot of products that they might, quote unquote, illustrate well, but then they've got this red tape when it comes to trying to get access to your money. And you need the right structure where ultimately this might sound silly, but we actually want to legally purchase you the lowest amount of death benefit possible, so you have the highest percentage of your premium going into the cash value. And that really gets into why is it that most agents don't or won't do this correctly. I remember 4 years ago when I read the book, What Would the Rockefellers Do? I decided we're going to start doing this play for our family. And then as I really dove deeper into it, I said, hey, I'm gonna make a career out of this. I remember I reached out to a local friend of mine here. I actually coach a couple of his kids. And I told him, it's like, hey, I'm gonna start I'm going to get my life insurance license and I'm going to start helping people with infinite banking. He had been a full-time life insurance agent at that time for like 4 or 5 years. And his response was, what's that? He never heard about it. He didn't know anything about it. I wasn't even licensed yet. And he took me out to coffee to break it down for him and teach it to him. Right. And this is why he's a great guy. Again, I coach his kids. We're friends with his family. But remember how I was critical of money guys a few minutes ago when I was talking about, when all you have is a hammer, everything looks like a nail. Well, the same is true in the insurance space as well. So this is completely different than term insurance. Term life insurance is super important. I have $3 million of term on myself. I have, a wife. I have 4 kids. I've got a daughter. Going to give her the wedding of her dreams one day, Lord willing. And so those are important. Those are important expenses that, even though I understand that the vast majority of term policies never pay out, as a responsible husband and father, that's taken care of, right? Okay. So term, you base upon, anticipated future expenses, and God forbid something happened to you, there would be enough to provide for your family. That's not how we want to approach whole life insurance. So we're basically going to ignore the death benefit. Okay. But so the way you want to think about it instead is, how much money per month do you want to be systematically funneling into your whole life insurance policy over a certain period of time? It's 10 years, 20 years, 30 years, however long that might be. So if you go down the street to Joe Blow insurance guy and say, hey, I was watching some TikTok videos where I checked out the Zoom on infinite banking. Can you do it for me? He's almost always going to say, yeah, sure, I can do that for you. But this is where the structure part comes into play. So how most people in the space, like 90% plus of agents, are going to structure, if you said, hey, I want to start putting $500 a month in my policy, he's going to structure your policy where $500 a month goes towards the death benefit. It's called base premium. $0 per month is going in your cash value. Here's why. Because as life insurance agents, we only get paid commissions on selling death benefit. We don't get paid commissions on selling cash value. So whatever his commission rate with that carrier might be, he'll get paid a commission on the full $6,000 of volume, right? $500 per month times 12 is $6,000 for the year. So his annual volume for that policy would be 6,000, then whatever his commission rate is. But that is not going to help you do any of the things that we've talked about so far in the Zoom that we are going to cover. So the way to do it better, and these are just approximated numbers, but instead of that same $500 a month premium, what we want to do is we want to take that premium down at least 70%, to where the base premium in this example would only be $150 per month. So at least $350 a month of that policy is going into the cash value instead. And the challenge, that's going to help you get all the benefits we talked about. But the challenge for that agent is his commissions now, instead of paid on a $6,000 volume, is paid on an $1,800 volume, which means his commission, it's the same amount of work. Honestly, it might even be more work to do this the right way, just because there's a bigger education component. But it's the same amount of work, possibly more. And he literally makes 70% less commissions. So if you can imagine, most people get in the space, you just don't know what you don't know. So there's not a lot of firm owners out there who are training their agents how to make 70% less commissions, right? So you can imagine that's why it can be challenging for a lot of folks to find the right resources, find the right policies. Remember, the 3 things you need again are the right carrier, the right policy, and the right structure. Okay. So let's dive real quickly into the term versus whole life and give you kind of an analogy to help you understand this. So these are just national averages that I Googled, and you go Google them for yourself. So you can kind of think of like term versus whole life, like renting versus owning a home. So, the average rent right now in the United States, of course, that completely varies depending what market you're in, is, $2,174 a month. So imagine while term policies, 99 out of 100 term policies don't pay out. And thank God, right? Nobody wants to die early just to leave their wife and kids money. So thank God that that the vast majority of term policies don't pay out. But so you can think about, like, if you rent a house, you pay that $2,174 per month, it's national average. After 10 years, you move out, you have $0 of equity, right? You paid rent. It doesn't mean it was a wash. Like you didn't lose out. Renting a home still provided shelter for your family. You had a roof over your head. You had a place of safety and warmth and protection from the elements and stuff. So you still received value even if you didn't get equity with it. But the reality is, you could, instead of renting, you could purchase. You're going to have a down payment with that. You might have a slightly higher mortgage. Currently, the average mortgage payment is just, what is that, $35 a month more. Of course, there's a down payment involved, but so with the down payment involved, a slightly higher monthly payment on the mortgage, after 10 years, currently, the average homeowner who has owned their home for 10 years has $225,000 of equity, right? And so that you can think of that same way with whole life and term. there's going to be a greater cost on the front end to set up a whole life policy than if you just got a term one. Okay, but then you're building that cash value account and where you're getting, tens of thousands, hundreds of thousands, possibly millions of dollars of equity, of cash value, accessible cash value in that over time. And that becomes really powerful there. So term, even though we're talking about whole life insurance here for the infinite banking concept, I don't want to fail to touch on term for you because more than half of Americans do not have life insurance. The majority of those who do have life insurance do not have enough life insurance. Okay. And the majority of those who have any life insurance are overpaying between 30 and 50%. There's a lot of reasons why of that. If you do not have life insurance, whoever invited you on here, like get with them, let them run you a free quote for sure. Like it's many times so much more affordable than people realize. And it is way too important to not take care of for how simple and quick and easy and inexpensive it can be. Definitely avoid MLMs when it comes to purchasing life insurance. I love network marketing. My wife and I have made millions in the network marketing space. This is not network marketing in no way what we're talking about here, but there are a lot of MLMs out there. While I love network marketing, support network marketing, I'm enrolled in a network marketing company currently because I love the industry. The reality is those companies work because they have proprietary products or services, right? There's nothing proprietary about life insurance. I mean, life insurance is life insurance. It's a number of years, an amount of death benefit, and a certain premium amount. The reality is those MLMs are the most expensive, but there's tons of them out there where most people just don't simply shop around. If you've not gotten your life insurance updated in the past 24 months, the past 2 years, you've got to reach out to whoever invited you on this, have them run you a free quote. It literally take you 2 minutes to get a free quote. And if it doesn't save you money, you're out nothing. Most likely it's gonna wind up saving you tens of thousands of dollars of future premium increases that you are not aware that are coming through your current policies. That is the most common thing. Again, a quote in 2 minutes, you can be approved in 5 minutes. It's a super simple process. And just one thing I know from being in this space for almost 4 years now is your family's never going to be upset that you had too much life insurance. Okay. So again, we already talked about how the difference of term versus whole life is kind of like renting versus owning. Again, think like buying a home, right? There's an initial cost of insurance with your whole life policy, but it's because it's going to lock in a guaranteed tax-free death benefit in the future. Okay. And so you can think about how that equity continues to grow. And just like when you have equity in your home, you can access it through a HELOC. Okay. You can think of that same way. You can use these generous loan provisions to access that equity inside of your whole life policy. Many times that cash value is growing tax-free between 4.5% to 5.5%. And because it's completely liquid and accessible, you can use it to fund any types of purchases and investments that you have in the future. But now what's important to understand is this product itself, although the money does grow, you don't want to think of this as the investment itself. That's not really what this is designed to be. Although some people do that. They just pay money into it. They don't do anything else with it. And then they retire and they just withdraw a tax-free retirement income. You can do that, but that's not really the best way to use this. There's really kind of 3 levels to how to implement this play. The first one, again, is this should just be your family's systematic savings account emergency fund, right? So if you're throwing $500 a month into your savings account at whatever bank right now, you can simply redirect that and start putting that $500 a month into a whole life insurance premium. It's going to be arguably just about as liquid and accessible for you. And we're going to talk about the emergency fund benefits in a minute. So what's important, I already mentioned this earlier, is while a lot of people focus on rate of return, I would make the argument that rate of results is significantly more important. And that gets into like the second level of this. The first level, again, is this is your systematic savings account emergency fund. What this starts to become then in your second level is this gives you, this is your opportunity fund where you have access to capital. And again, like you might like other things that have great growth. Like I love crypto. Crypto is awesome. Where I'm not here to promote crypto, but crypto, as great as it is super volatile, right? So you might have had 100,000 if you had one Bitcoin a couple months ago, you had 100,000. Now you have 87,000, right? And who knows, 6 months from now, you might have 150,000. It just goes up and down. But so if you're wanting access to that money to fund other investments, that may not work as well. This is arguably the lowest risk place you can put your money. You know, we look back through history, many of these A-rated dividend mutual life insurance carriers, they've been paying a profit every single year. Some of them going back as far as the Civil War. Yeah, I mean, pretty much all of them turned a profit every single year through the Great Depression. In the Great Depression, 90% of the stock market was wiped out, 40% of banks closed, and pretty much anybody who had money in an A-rated mutual carrier, every single one of them didn't just keep their money, but they grew their money through that time frame. And so let's talk about emergencies and how using this as an emergency fund can really be a powerful play. Because when most people talk about emergency funds, typically they're only talking about if, like, God forbid, you lost your job and you have a few months of living expenses to float you until you find a new job. That is absolutely great and important, but it's incomplete. There's more to an emergency fund than that. The reality is, for most families, the biggest emergencies from a financial standpoint tend to be medical related. Okay. And so that gets into one of the big benefits you can have with this play here, because of the living benefits that you can have in place. Let's use this example. Let's say that you had $500 a month you're currently putting in your savings. And so over the next 4 years, okay, over the next 4 years, if you put that $500 a month away over 4 years, that would be approximately $24,000 you'd have in your emergency fund. And that's responsible. That's helpful. That's a good thing to have. Absolutely. Okay. But what if instead you were putting $500 a month into your premium with your infinite banking policy emergency fund instead? You would still have approximately $24,000 cash out. This does depend a little bit upon health ratings, approvals, age, that stuff, but you'd have somewhere in that ballpark of around that same amount of cash value. But you would also have probably around a $200,000 death benefit. And so what's interesting is, with these policies, you have living benefits where if, God forbid, there was some sort of critical emergency, chronic illness, terminal illness, you can get access to up to 75% of the death benefit while you're still alive. So in the second scenario, putting the same $500 a month aside for 4 years, if you did have some sort of medical emergency like that, you could have access to up to $150,000 in your emergency fund, put in the same amount of systematic savings away like that. So do you see how, again, remember the Swiss Army knife of financial tools? Do you see how this starts coming into play now? Where it's not just, can I grow my money? It's, can I access my money? And it's, can I use this to protect my money against other unexpected life events and expenses that come up? That's where this asset starts separating itself from other financial plays that are out there. And again, remember, this in and of itself should not be the investment. This is the foundational play that you're building over time to fund future investments. So let's talk about a couple of quick things that you should avoid in this process. Definitely exaggerated illustrations. If you start seeing people who are showing you 10% a year, 12% a year, 14% a year, that it doesn't exist out there. Does it exist in a short term? Yes. Are there people in their IULs who got 14% last year? Yes. But is that what they get year after year after year? No, that is not what they get. And so just be careful, because at the end of this, if one of the most common questions families tend to have is, hey, this sounds interesting, but what does this look like for my family specifically? If you kind of find yourself there at that point, at the end of this Zoom in the next couple of minutes, definitely get back with whoever invited you onto this, whether they're an agent or they can get you connected with one of us on the 818 financial team. They'll be able to show you what this looks like specifically. But my point is, there's always going to be an agent who is maybe a little bit more aggressive and wants to show you something that looks really great, but it's completely unrealistic. Okay, so you got to be careful of that. Also, you got to be careful with aggressive premiums. Listen, we earn commissions in this business, right? I mean, we have a financial interest in helping clients open these policies. I would hope that we do it with integrity. I would hope that we do it from a servant perspective and trying to help you get the right thing for your family. But the reality is, I mean, there's some guys out there that they over exaggerate how great this is. And they'll say, if you make $100,000 a year, you should run $90,000 a year through your policy, take policy loans, finance your gas, your groceries, your food, all that stuff. And that's not how this is designed to work. Again, like we talked about, this should start as a systematic savings account that is an emergency fund that then grows into an opportunity fund. And so IULs can work, so you guys know. IULs can work, but they are oftentimes sold the wrong way and misrepresented. And it's not most agents' faults. Most agents have been trained poorly on them. They don't understand what they are. So make sure that you are looking at the contractual guarantees and asking follow-up questions. And again, if you have questions on how to do that, I mean, I could absolutely help you with an IUL. Well, that's not what we tend to do. That there's definitely places where that can make sense. An IUL is an index universal life policy. You definitely want to work with an agent who personally practices this. Yeah, if they don't, it just they might be well intended, but they don't know what they're doing, right? Because if they understood what this was, they would be practicing this for themselves personally. So here's a simple question: just ask them, how many of these properly structured, high cash value, whole life insurance policies do you have in your family? Like I love telling clients, I have 5, and we're going to hopefully begin our 6th soon. It's a great financial play for our family, and I can share stories and examples about how we've used this and what it's looked like for us. Okay, you want to watch out for high surrender charges. Sometimes they put really big numbers on the cash value account, but you can't actually access it because they hide it with surrender charges. And you definitely need great loan provisions. It doesn't do you any good to get 10% growth on your money if they charge you 12% loan rates to access it, right? So all of those things are things that you want to avoid and be able to look out for. I'm going to try to land this plane here soon. So just real quick, why should you borrow your money? It simply has to do with creating interest arbitrage where you are putting your money to work in both places. So you're having your money work and grow inside of the policy, and then you borrow against that money. So you don't withdraw it, you borrow against it, and you put it to work somewhere else, whether it's for major purchases or whether it's for funding investments. Either way, that is the ideal way. So just real quick math. So let's say you took a $30,000 car loan out, and the loan rate on your policy was a 4% fixed rate, okay, which currently one of our carriers, that's exactly what they offer. So you get a 4% fixed loan rate, and you decide you're going to pay it back over 5 years. $30,000 loan, amortized at 4% for 5 years, you would wind up paying back $3,100 of interest across those 5 years. Okay. So there's a cost to the loan. But check this out. Because that $30,000 stayed inside the policy for the same 5 years, and let's assume that it only earned 4%. Many times these can see 5.5% growth. Okay. But let's assume that it only earned 4%. Because it's uninterrupted compounding interest instead of amortized interest, you would earn $6,500 on that same $30,000 over 5 years. So you would net out $3,400 of interest savings by running the purchase through your cash value account and then repaying it back into the policy over the 5 years instead of repaying Nissan, Honda, Tesla, whomever you'd be purchasing that from. Okay. So we talked about the first level is the emergency fund. The second level is an opportunity fund. The third level is that legacy wealth hack. What's awesome about this was, again, when you do it right, you structure it the right way, all of the things that we've discussed so far, is you're going to get to a point, 10 years, 20 years, 30 years, whenever it is, that you decide, I don't want to pay a premium anymore. What's really cool at that point is because the cash value is so high and it's earning such a high amount of interest and dividends, the policy will self-fund it. The technical term is called reduce pay up the policy. But essentially what you're going to do is you're going to take your premium payment to zero. The cash value is going to be fully intact. The interest and dividends are going to self-fund the death benefit for the rest of your life. And from that point forward, you're going to typically see between 5 to 5.5% growth in your cash value account every single year, while you're seeing about a 2.5% growth in your death benefit account every single year, pending dividend returns. But looking at what they've consistently been, that's about where they are. And you create a scenario where the older you live, the higher the tax-free death benefit is ultimately going to be for your family, which is powerful. And that, again, that's the whole what the Rockefellers do method that I talked about. If you want, of course, you can buy the book on Amazon. If you want a free audio copy of that book, just message me, or again, any of my agents on the 818 team who invited you onto this tonight. We can send you a free audio copy of the What Would the Rockefellers Do book. But it shares how for 7 generations now, they have moved hundreds of millions and billions of dollars tax-free from generation to generation to generation, utilizing this exact same place. So you might say, I don't have hundreds of millions of dollars. That's okay. But if you start it with thousands of dollars and then tens of thousands of dollars and then hundreds of thousands of dollars, you can still create that same type of financial efficiency for your family. So just some observations that I've had. I'll land this plane here for you guys. Some observations after helping hundreds of families with this across the country the past 3.5 years. One is, I already shared this, your family's not going to be upset that you had too much life insurance when you pass. So that's one thing to consider here. Something I know to be true is the longer this is enforced, the better it gets. Remember, I shared, I knew about this play for close to 10 years before I put it in force. I kick myself all the time. Man, I wish I would have done it. When in 2013, I wish I would have done it in 2012. Yes, but I couldn't do anything about going backwards at that point. So once I figured this out 4 years ago, it was simply, okay, I know that we need to do this. I'm not going to put it off any longer, because the longer it's enforced, the more you get compounding on your side. You can start small too. And some of you might even be saying like, well, I'm not insurable. That is a scenario for some people. You can take policies on anyone you have an insurable interest and you still own and control the cash value. Kids, grandkids, business partners, key employees. So there's a lot of strategies. So again, so don't just write yourself off of this. And you don't have to put thousands and thousands of dollars into these to get them started. You can start them with just a few $100s a month. And so again, because the longer the compounding is working for you for that ultimate tax-free legacy wealth transfer, you don't want to put it off because of misinformation or unanswered questions. Again, if you go through your process and decide, hey, this is not for my family, that's great. But I strongly encourage you to not miss out on it over unanswered questions. Another important observation, having it is good, but learning how to use it is better. We've gone through some examples. There are a lot more examples that we can touch on. We just simply don't have the time to do that right now here on this tonight. But that's, again, why scheduling a wealth strategy session with one of our team members would be really the next best step for you to do there, because there's so many creative ways that you can create more efficiency. I could go through story after story. I mean, I have a friend whose 17-year-old son started a Turo business where he rents cars through his cash value whole life insurance policy that started. The friend bought a house. He lost a job, bought a house, financed the entire house purchase through his policy, got a new career, and didn't pay a mortgage payment for 12 months because of the flexibility of the loan provisions, right? Like there's so many amazing ways that you can apply this. And so again, having this good, but learning how to use it is better. And so, and remember, I said the ideal strategy is to have both whole life and term. It's not an either or. And that's usually people pitch in either way. Even by saying you all you need is whole life, that would be inaccurate, because the death benefit on my whole life policies is not enough to make sure that my 4-year-old daughter's wedding is paid for one day if God forbid something happened to me, right? And so that you have a high term amount in the early years with a low premium cost, while you're building your whole life in the background, so that when that term expires in the future, you don't have to renew it at a crazy high premium rate, and then the whole life just overtakes it and replaces it then at that point. We're going to talk about how not all agents are created equally. So I strongly encourage you, whoever invited you out to check this out tonight, get with them, ask them your questions. Don't miss out on what this could be for your family because of skepticism, or because broke Uncle Chuck said something, or Dave Ramsey yelled at somebody. Make sure that you go through your process, because truth is true, whether people have opinions about it or not. And if you continue to go through the process of understanding this, growing your financial IQ, seeing real life examples of what this could be for your family, I have a high degree of confidence that you're gonna realize what this could really be and something that you want to implement. But so don't miss out on that. Be sure to reach out to whoever invited you on here tonight and schedule your free wealth strategy session with them today. So thank you guys so much. Have a great evening. God bless you.